Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I am Reema Tendulkar, and let me welcome the new Trading Hour team. We've got Sonal and Hormuz, and three of us are going to be with you every day from 11 o'clock to 12 o'clock. Unfortunately, as we begin the straight and the show, the week and the show, is that this holding pattern for the markets continues, right? Pretty much unchanged from what happened last week. Consolidation. I guess still waiting, right, for the big events to play out in terms of, details on tariff, earnings season. Before now, things appear to be quiet at the index level. Individual stocks, of course, are doing their own thing.
That continues to be the case, right? Hi, Hormuz. Hi, Reema. It's going to be a right with the three of us. I'm sure about that. But for the markets, it's very quiet right now. As Reema has pointed out, it's a very stock-specific market. And the basic thing and the most important thing that the markets are watching out for right now is what happens with the US-India trade deal. We, of course, have the earnings which would come up soon. So we keep getting all these. Okay, there's a sudden spike, actually. I told you we'll be a riot, right? That's what has happened to the markets as well. There's a sudden spike, and it is led by Nifty Bank. So Nifty Bank constituents should come up for you on the screen. Some of them leading to the gains from the lows of the day. So we have something like an SBI, which is spiking from the day's low. We do have Kotak Mahindra Bank. That too is in focus. Axis Bank should be the other one. These stocks are leading to some of the gains that we're seeing from the lows. But again, Q1 updates, that continues to be in focus, Hormuz.
Hello to both the ladies. And yeah, at the start of the week, and it's the banking names that are working higher. And HDFC Bank is not far behind either. That too has moved into the green and doing fairly well for itself. A 63-point contribution to that 100-point move that you're seeing on the Nifty Bank. And that has led to that revival on the Nifty as well. But of course, there are a lot of other movers in the broader markets today. And we're no short of losers. Look at Info Edge. It just came out with a business update a few minutes ago. And that stock has taken a bit of a nosedive since then, almost 5% lower on the stock now at the lowest point of the day. And the other one being Endurance Technologies is seeing some bit of profit booking, and Jubilant FoodWorks, after a fairly decent quarterly update, is still trading lower by around 3%. And this despite being the analyst commentary being fairly mixed on the stock. So now, since we are on the subject of Jubilant FoodWorks, let's get Mangalam in to talk more about that update. And on the flip side, the stock that's doing well, which is Godrej Consumer, to shed some light on that as well, Mangalam.
Well, it's a very good performance that has actually come in from Godrej Consumer, and that's reflecting the stock as well. The one thing that stands out in all the consumer updates that have come in over the weekend is the fact that it seems like the worst of demand woes is behind. Yes, we've been seeing rural recovery come by over the last few quarters, but this time around, urban is also showing signs of recovery. The standalone business for Godrej is likely to deliver high single-digit value growth driven by mid-single-digit volume growth. And that business is led by home and personal care along with their, overall business as well. And that's largely on account of volume growth, which has been strongly competitive and sequentially improving. The last couple of quarters for Godrej Consumer were marred by high inflation in palm oil prices, which the company believes is behind, but they're yet to see margin impact of that one. They believe that will happen in the second half of this year as they exhaust all the high-cost inventory that they have. So all of this with an improving outlook for domestic business seems a lot better, and as a result of which this stock is being fairly well bid up in today's trading session. Personal care expected to grow in low single digits, home care expected to grow in double digits, and standalone EBITDA likely to be slightly below normative range but expected to improve. On the flip side, we have Jubilant FoodWorks. Now, the stock has been doing a lot better than all the other parts of the consumer market, and as a result of which it was fairly well bid up, and brokerages were not very comfortable with the valuations. But that's not to take away from the fact that their update was fairly strong. 18% standalone revenue growth. Consolidated growth was 17%, but that was, impacted by weak performance that the company reported in Turkey. No problems for the India business. The Domino's like-for-like growth in India has come in at around 11.6%, marking the third or fourth straight quarter of positive growth and the second straight quarter of double-digit growth in like-for-like as well. And they've opened 60 Domino's stores in India during this quarter, taking the overall count to around 2240. Weakness in Turkey, same-store sales growth down 2.2%. They've added 7 stores. But for Turkey, more than Domino's, the smaller part, coffee, will be something that we'll be watching out for when the company reports its actual numbers. So on the back of a decent update, but limited headroom for valuations has led the stock to see some profit taking today.
Mangalam, what's the valuation of Jubilant?
Trades upwards of 70 times.
Upwards of FY27?
Yes.
Okay, so that is capping, the moves in the stock or the upside. But as he pointed out, the update was pretty okay. Vivek is now joining in for more on Borosil Renewables.
Well, that's right. So Borosil Renewables is in focus. Now, the company last evening gave an update to the exchange stating that one of the German subsidiaries that the company has that's called as GMP. Remember, GMP is a material subsidiary, contributed almost 22% of the total top line as far as their FY25 operations was concerned. Now, due to similar issues that the company was facing in the European market, similar to what India was facing due to dumping of China's glass, is something that the company said was unviable for continuing operations as far as GMP was concerned, and the company went ahead and filed for bankruptcy as far as the German insolvency court was concerned. There will now be an administrator who will take over operations of this particular subsidiary, and the company will then engage with the government authorities to go ahead and ensure what exactly can be done. Our company spoke to us earlier today. They've said that all options are on the table, and in fact, if they get some support from the government, they may even consider reopening the furnace. The furnace has been shut down since January of last year. Look at the financial impact. Number one, like we said, 22% of the total financials in FY25. The total exposure of the company clarified to us stating that there are no third-party exposure, only total exposure of close to 350 crore, cash loss of 9 crores per quarter, which will get arrested now, and going forward, all expenses and cash flow of the subsidiary will be done by the German insolvency administrator.
Okay, all right. Thank you, Vivek, for joining in and giving us all those details. We spoke to the management as well, as Vivek just pointed out. We'll do one thing. We'll slip into a short break now. When we come back, we'll discuss what's buzzing in the commodity space with Manisha Gupta.
Welcome back. Shifting focus now to commodities, and Manisha is joining in to talk about rubber. The futures were in a firm grip, but then they seem to be coming off their one-month highs, Manisha.
Oh, well, yes. There are many more fundamentals which have been supportive for rubber. But yes, after hitting a one-month highs in the previous week itself, we are trading with some profit-taking at this point in time. It has to do with the easing crude oil prices, because that is what you use when you want to make synthetic rubber. And if those prices continue to decline, then that weighs onto the natural rubber prices also, exactly what we're looking at in the markets right now. Also, even as we're dealing with slightly weaker demand in the European markets, the latest numbers also show weak demand and higher inventories in China. Remember, China is where 40 to 50% of natural rubber, even synthetic rubber for that matter, is consumed. There are supply concerns because of the adverse weather conditions, whether it has been about Thailand and China, is the reason you saw the prices going higher. And the markets do believe that you wouldn't be looking at prices really declining further from here, because as per the report of Association of Natural Rubber Producing Countries, when you look at the year 2025, the output is anticipated at 14.9 million tons, but the consumption much higher at 15.6 million tons. So buy on dips perhaps is a strategy you could be looking at working within for rubber.
Thank you very much for that. That's the update coming in on rubber. But let's get to the big interview of the day. Remember last week we told you the Ministry of Defence has cleared 10 capital acquisition proposals worth more than 1 lakh crore rupees. These proposals will be carried out through indigenous sourcing from Indian companies. My colleague Parikshit spoke to the Defence Secretary R.K. Singh and began by asking him about how the acquisitions will benefit both the private and the public sector. Listen in.
This particular tranche of approvals, or accord of necessity as we call it, is, the unique thing about it is that all of these, 100% of these are meant to be in the category of what we call indigenous design, development and manufacturing, IDDM. All of these projects rely on domestic technology, domestic design, and therefore the entire IPR will remain with us. Many of these are with DRDO, based on DRDO technologies. Others are with different technology sources. So yeah, it's an important sort of reaffirmation of our belief in self-reliance. Increasingly, you will find that IDDM is where most of the procurement will come from. And more importantly, increasingly, you'll see that most of these DRDO technologies will be utilized by the private sector through its DCPP model. Many of these projects are also in those categories. And most of the projects, therefore, will be done by a combination of public sector and private sector industry partners, but using domestic technology, as I mentioned.
I would also
like to get a sense from you on the AMCA program. An expression of interest has been issued. By when do you want to conclude the awarding of contract?
Well, you are correct. The RFI has been issued by ADA, our Aeronautical Development Agency, and I think they've had some preliminary rounds of discussions with prospective bidders. The timeline is a little difficult for me to say because, frankly, I have not checked with them. But I would imagine it will take something between 3 to 6 months to, to reach the contract award stage. Thereafter, the project itself of development and of an AMCA prototypes, actually taking to the skies, it should be about a 10-year program, I would imagine.
Could you also list out the major investment opportunities for the private sector and the public sector right now in areas which are going to be a priority for the government and will remain a focus of government capex, according to you?
I think we've made it clear through our budget allocations that we are going to do 75% of our budgetary outlays are going to be spent within the country. And these will cover vast areas of our defense domain, including aerospace and aviation, naval shipbuilding, where out of 60 odd ships under construction, 59 are being built within the country. Land systems of various types, where we have good capacity already. Missiles and munitions, where a lot of the systems integration is done by the public sector, but there are a large number of private sector players who play a role as component manufacturers and vendors. Also in areas like electronics and communication systems, emerging technologies like artificial intelligence, robotics, and of course drones, where there is a significant allocation available for good Indian private sector companies and public sector companies for that matter.
Speaking about the defense budget, considering our experiences from Operation Sindoor and how India will now focus a lot on cutting-edge technology in the defense sector, are we expecting the Defense Ministry to make a recommendation for a significant increase in the defense budget in the next union budget?
I think the short answer to this is that on the CAPEX side, there's never been a constraint, actually. There has been a constraint in terms of our ability to actually fully utilize our budget. And we've done it last year, and we are well on the way this year of ensuring that our quarterly expenditure targets are met. So based on a faster pace of expenditure, we can ask for additional money during the revised estimate stage if it is felt that the requirements are more. So I would say that we are, it's likely that we might need additional allocations in the long run, but it really depends on absorptive capacity of the industry, of our own ability to spend money quickly, to sign contracts faster, to take procurement decisions faster. So that process now we've kind of improved significantly last year. I keep saying that we did 2 lakh crore of contract signings last year, which is the double of any previous year, and the highest previous year rather. And we intend to keep up that pace. And if we keep up that pace and we ensure that there are enough committed liabilities and ongoing purchases, then I'm sure we can persuade the finance department to give us additional CAPEX. They've promised to do so always.
Right.
If you're asking as a longer term issue, as far as the Finance Commission is concerned, for the 5-year cycle of the 16th Finance Commission, we are going to be seeking additional allocation to the extent that our defense share in the GDP goes up from the current figure of about 1.9 to about 2.5. But that is a sort of broader, longer term, or rather medium term sort of request that we intend to make.
Right. And in the revised estimates, sir, are you going to seek additional allocation, keeping in mind the current procurement cycle?
I wouldn't be able to say right now, but since we've done some additional, some quick procurements in fast track under the emergency procurement, and there could be some other fast track procurements as well. So if our pace is such that we need additional allocation at the RE stage, we'll think about it. As of now, it's a little early to say.
Okay, that is the commentary coming in from Defense Secretary. It's an exclusive interview, and we keep getting you updates from that conversation through the course of the day as well. But remember to tune into the all-new CNBC TV 18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV 18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV 18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Welcome back. You're still tuned into Trading Hour on CNBC TV 18. Markets absolutely flat, very stock-specific action that we are seeing. So it's a good time to get a technical check on the markets as well. Soni Patnaik from JM Financial Services is joining us for just that. Soni, good morning. Thank you so much for joining in. Been quite volatile. We did see that recovery from the lows. That has been sold into absolutely flat on the Nifty. What is the next important level to watch out for?
Good morning, Sonal. Thank you so much for having me on your show. I think Nifty may continue to consolidate in a broad range between 25,300 to 25,700 for another week or so. And this consolidation range or any declines up to the support levels towards 25,300 to 25,000. So that range, if a decline can be seen, it's wise to initiate a long strategy. I think it has a very strong support for the series towards 25,000. It may defend those support levels and bounce back. But a fresh breakout can only be seen if it's crossing above 25,700 odd levels. So I think one has to wait till the consolidation plays out. Similarly, for Bank Nifty also, 56,500 is playing out as a good support, but it is also in a consolidation range. And any fresh breakout in Bank Nifty can only be seen above 57,500 to 57,700 range. Until then, it's wise to adopt a stock-specific strategy, as movement can be seen in stocks and sectors more than the indices as of now.
Soni, good morning. Thank you for joining in. What are those stocks then?
Hi, good morning, Horma. So we have two official recommendations today on the buying side. One is to buy Tech Mahindra on current declines as of today in the price range of 1628 to 1636, keeping a stop loss of 1554. A positional target towards 1720 to 1750 levels can be seen. So it's a positional play and one can accumulate in these declines. The second buy pick is in Bharat Forge, which has crossed above all its short-term moving averages and sustaining above a strong support of 1270. So one can buy Bharat Forge at current levels with a stop loss of 1254 and a positional target of 1360 to 1400 plus levels can be seen.
Thank you very much for that. Let's talk about IT, because come Thursday evening, TCS will be reporting their first Q1 numbers of FY26, and IT has been an underperforming sector. Year to date, the Nifty IT index is down 10%, while the Nifty is up 7%. So it's underperformed, at the index level by nearly 17%. Ravi Menon, IT services analyst at Macquarie Capital, is now with us on the show. Ravi, thank you very much for joining in. So, just last week you released a report where you've added Tech Mahindra to your marquee sell list and you removed HCL Tech from your marquee buy list. So let's walk us through the rationale behind this action as we begin this conversation.
Morning, everyone. Good to see you. Two things here, right? So Tech Mahindra, we think valuations are too high. It's the most expensive stock among the large caps. We think the turnaround plan for the firm, to get to peer group average growth, exceed that by FY27, and to get a 15% EBIT margin. Not easy for the management, especially given overall industry growth. It's also not been great last year, and looks like this year is also going to be tough. With this industry, you have 90-95% of your revenue coming from existing clients. So changing your book of business takes years. So I think changing profitability, changing your growth profile, that's not easy for a company with $6 billion in revenue, like TechM. Smaller firms of $300-500 million revenue, it might be just addition of a few large clients or a couple of large deals, that might be enough. But for such a large firm, I think not easy to do it in 2-3 years. That's why we think Street is wrong to assume that the targets will be met. So we see potential for downgrades here in Tech Mahindra. So that's why we've added to the marquee sell list. HCL Tech, it's done exceedingly well since we added it in May 22. More than 80% returns, more than 20% CAGR returns in that. Now HCL is trading at a premium to TCS and Infosys. We do think that medium term HCL Tech will continue to grow faster on these firms, but over the next 12 months, this Asia marquee, it's a model portfolio for the next 12 months. So over the next 12 months, we think TCS can potentially give better returns as we see margin expansion for TCS back towards the 26-28% band, which should lead to a re-rating. Well, for HCL Tech, we don't see any near-term triggers like that. We do see a near-term trigger in terms of higher order wins for HCL Tech in the next quarter, but that we think is too little to justify having that about TCS.
You said Tech Mahindra. Got it.
Sorry.
TCS is a part of your
Marquee buy list.
marquee. And is that the only IT stock in your marquee buy list, TCS?
That is correct.
Okay. You said Tech Mahindra is the most expensive large cap IT stock today in terms of valuation. What does it stand at, and how much of a premium is it compared to long-term averages, and what would be the appropriate valuation multiple for Tech Mahindra?
All right. So Tech Mahindra on our numbers is at more than 30 times FY26. Compare that to Infosys at 24 times, HCL at 25 times. LTM Mindtree is trading at similar valuations. You could say marginally below that of Tech Mahindra, but we see that as a firm that can grow much faster than Tech Mahindra. Even FY27, Tech Mahindra is at 25 times, FY27, more than like a 10% premium to HCL and Infosys, and like nearly a 20% premium to TCS, which we don't think is deserved. We think that it should ideally trade at a discount. So we are valuing Tech Mahindra on 20 times. So that's the right multiple, we think.
And just talk to us about this TCS. Your thesis that TCS will be able to return to its aspirational margin band of 26 to 28%. I was looking at so many consensus expectations over the next 2 to 3 years. None of them expect margins to go back to above 26% despite a lower contribution from the low margin BSNL deal. So, Macquarie's estimates appear to be a bit of an outlier here. And that is the key reason driving the potential re-rating in TCS. So explain to us, how do you think TCS will get back to these margins?
All right, Rima, as you know, they don't disclose utilization levels. We think that they have a lot of buffer capacity, which I think they've not been able to use because deals have been a little slow in coming through in the last couple of years. There are a lot of cost takeout deals right now in the market as per our channel checks. And we think, as the BSNL contract goes away, they will have that margin flexibility to take on some of this and put some of this unutilized capacity to work. So in a way, you could think about it as there is bench that is right now not utilized. And that's what we expect to help margin improvement for TCS.
Okay. Ravi, this is all about large caps. So what's your take on the mid-cap IT space? Do you think there will be difference in how these companies perform versus the large caps this time?
I do think so. They will definitely continue to grow faster. This is the trend we've seen from 2018, 2019 onwards. With digital deals, they are smaller. So the small vendors can also actually have an equal chance of winning some of these deals that are, especially in the 20 to 50 million mark. Our topic there is persistent systems. We also like LTTS, where we think that can potentially be a beneficiary of this whole supply chain re-engineering that's happening across the world. So their plant engineering segment can see benefits from brownfield and greenfield expansion for plants.
Ravi, good morning. Thank you for joining in. What about Infosys then? There has been a lot of chatter around the fact that these acquisitions that the company has closed in the last couple of months, that would help them boost their guidance for the full year. Now from 0 to 3%, do you foresee an increase in guidance this time around? And if so, do they have the potential to meet that guidance going forward by the end of the year?
That's a really good question. Like the acquisitions, definitely that has not been factored in. So raising the guidance will be natural. But at the top end, we think it's a bit difficult. We have seen in the last 3 years that the guidance that they've revised up through the year, they've not been able to meet it for 3 years. So I would be skeptical about the top end of the guidance, even if they raise it.
Will that be disappointing? that despite an acquisition, they will not be able to achieve the top end of their earlier guidance.
That would be disappointing, and that would make it the fourth year where they would be missing guidance. I think that's why we prefer TCS and HCL over Infosys.
Okay, all right, Ravi. Thank you so much for joining in with that interesting conversation. Definitely, this is a sector we'll be watching out for closely. Earnings start this week itself, so it's going to be a busy week and months ahead for all of us. But with that, we'll slip into a short break. Management of Senco Gold will join in to discuss their Q1 update and the FY26 outlook.
Welcome back. Continuing to analyze the slew of business updates that were reported after market hours on Friday and over the weekend. Senco Gold was one of them. They saw their revenues grow by 28% and they also saw strong same-store sales growth led by festive demand. And to discuss more on this, Suvankar Sen, who is the MD and CEO at Senco, is joining in now. Suvankar, good morning. Thank you for joining in. You came out with a very strong update, 28% revenue growth this time around in comparison to what you have guided for in FY26, which is 18 to 19%. Does that give you conviction to up your guidance now for the full year, or would you wait for another quarter before you take that step?
I would be very confident to achieve the guidance that we have given, but to up the guidance, I would rather wait for another quarter. When we look at it, Q1 is one of those festive quarters. We have Akshay Tritiya, a lot of New Years in various states of the country, and the summer wedding season remains in the Q1 part of it. While in Q2, usually we do not have too many weddings, and the festivities are on the lower side. But the focus of Q2 remains to be such that we build up for the festive season that starts in Q3. So I would be, more confident on the 19 to 20% guidance that I have given. But our efforts and endeavor will always be towards, making sure that the numbers becomes better than what we can guide the market.
Okay, so looking to beat the guidance. Mr. Sen, morning. This is Rima here. Talk to us about diamonds. So you've indicated that the diamond volume growth was about 35%. What was the value growth in diamond, and what kind of margins on an average, on the whole, can you do in FY26? Can you do better than the 7.2%, the upper end of the 7.2% that you had guided for?
So the diamond value growth, if we look at it, the volume growth being at 35%, the value growth has been upwards of 45%. So, it's been a good comeback by the consumers with regards to their interest on buying diamond jewelry compared to what we saw in the previous years, Q1 and Q2, where there was a higher, I would say, inclination of the consumer to buy gold jewelry. And I think that at these high gold prices, consumers are looking at buying 14 karat, 18 karat plain gold or diamond jewelry, which falls within their budget. And there has been an effort from our side to continuously come up with new designs, create jewelry which is within the affordable budget of consumers. We've launched almost 5,000, 6,000 new designs in diamond jewelry and in gold jewelry during the Q1. And I think that it's a combination of various festivities and new design development that has led to the consumers have a need of buying such products and such jewelry. And when it comes to your EBITDA estimates, I would say that yes, around 7.2 is what we have said. And we have just ended Q1. While our efforts will be, and with the higher diamond sales, if it continues to happen, there is a probability of it going up. But for now, I think it's better to have our model with a 7 to 7.2% till we move and go closer to Q3.
Okay, so Mr. Sen, you mentioned there's growing consumer demand for 14K and 18K jewelry as well, right? How is this segment with respect to margins when it comes to this particular category? And will you be seeing more launches here? And in terms of store additions as well, will you do better than the 20 number that you had told us?
So we've already launched 9 stores, and in the Q2 we intend to launch 5 to 6 more stores, and then in Q3 the remaining. So while our efforts will be to take on the number 20 and go higher, but I think that till we are closer to 20, we might as well continue to with a focus on 20, while internally we will be focusing on driving higher numbers. And these products, which is diamond, which is these lower carated jewelry, there is a probability of a higher margin, but then again, we have to look at the overall picture. So there is this effort of balancing between growth and profitability. These products will help you with your profitability, but also in the 22 karat gold jewelry segment, since there is the discounting that happens, the gold prices are at a high level. We are offering great deals to the consumers. There are a lot of schemes that are being offered every month, every quarter. So we need to balance between growth and profitability and grow in a sustainable manner.
What about your studded ratio, Suvankar? It was up around over 11% in the fourth quarter. What has it been this time around, and what do you expect to end the year with?
The studded ratio has been close to 11%, and our effort is that to take it to 11.5%, 12%, and the growth that we are seeing in the diamond jewelry sales, we are optimistic that it will be upwards of 11%, closer towards 11.5 to 12, and that is largely led because of the high gold prices. So consumers, when it comes to gifting or their anniversaries, I think consumers are looking at diamond jewelry once again. And one thing is that the fall of diamonds that we were seeing over the last 1 year, I think that the prices of diamonds have come to a kind of a bottoming out, and people are now seeing that hopefully in a month or two, the prices will start moving up once again in diamonds.
So do you think you can do better than the 20 to 25% growth in diamonds that you had earlier guided for? Q1 has been extremely strong.
Ma'am, if you ask us, do we think we can do better? We can always do better and better and better. But the question here is that, wanting it, and then the external market conditions that are there, in which sometimes it's not totally in your control. But our effort will be that we should be looking at a good, strong diamond jewelry growth of above 20%.
Last question before we let you go. We know the market conditions are not in your hands, but promoter buying stake, will that continue? Because the stake has been increasing, 64.3% in March. Any more buying likely by promoters?
We'll have to, wait for the results to come out, and only after, there are these lock-in periods. But if you ask me as a promoter on the optimism and the positivity that I have towards the growth of the company, well, that remains positively strong. I can see the market opportunities are there. Yes, one has to look at very strategic way. What is the product that the consumers are looking at? What is the budget that the consumers have to buy jewelry? So as long as we are customer centric and having the right product, I'm sure that the growth for the company will continue to happen.
Just one final question. What percentage of your gold sales or jewelry sales comes from 14 and 18 karat?
The overall percentage would be around 12 to 13%.
And what was this number earlier?
The number was around 8 to 9%. So we are seeing that there is a steady trend upwards towards the 14 and 18 karat and modern designs, Western designs. That is something that we are seeing that in the 14 and 18 karat segment, it is moving up very, very strong.
And this is quarter on quarter, the change from 8-9 to 13-14?
I would say it's more of an annualized versus what we see in the quarter.
Suvankar Sen, pleasure having you as always. Thank you so much for spending time and joining us. Look forward to having you after your quarterly results as well. The management there of Senco Gold. Strong business update, but would wait for another quarter to raise their guidance for the full year. The stock in an upper circuit of 5%. Take a short break. The markets continue to remain where they are. Absolutely no movement whatsoever. But we discuss the road ahead with Dharmesh Kant from Chola Securities on the other side. Stay tuned.
Welcome back. You're still tuned into Trading Hour. Let's talk about market fundamentals now. Dharmesh Kant, the head research at Chola Securities, is joining us now. Dharmesh, good morning. Thank you so much for joining in. Well, we are just entering that earnings season. So for FY26 itself, what kind of EPS growth are you looking at? And which are some of the sectors which would contribute to the growth that we'll see this year?
Yeah, good morning and thank you for having me. I think Q1 should be again be a muted quarter for the earnings growth trajectory. It should be in a single digit kind of a zone. But for entire FY26, we are seeing around 9 to 10% kind of a growth on a base case basis. And on the upside, it can go up to 12 to 13%. And the sectors which are likely to do perform better is from the mainstream banking and financials are likely to do well. Though, I mean, a lot of catch points are there as to the NIMS compression and all, but to our mind, from Q2 onwards, the tailwinds will start paying out. And that is where the heavy lifting will be done. Apart from that, Reliance Industries, some support from the IT companies and the automobile sector is looking pretty fine to us. So these are the headline, sectors into the Nifty 50 basket, which are likely to drive the earnings growth going forward. So Q1 should mark the end of the transitory economic consolidation, which was there in the economy for the last 1 year after 3 good years of good performance. And this is a time to do your cherry picking.
Dharmesh, good morning. Thank you for joining in. You highlighted the list of sectors and including Reliance Industries that could lend some support to the earnings growth. But which are some of the sectors that you're cautious on going into the earnings season?
Yeah, good morning, Harmesh. I mean, the sectors which we don't like at all is one is the FMCG basket. Though a lot of buzz has been made because of the tailwinds of low inflation, lower interest rate, and the good monsoons, things are likely to pick up there. But look at the entire space. I mean, the entire space is available at a PE multiple of more than 50x and with ROEs of around 15 to 25% and a single digit kind of a growth. So I don't think the next decade is going to belong to them. It would be more to a growth sectors like defense, railway infra, construction, building materials, and the likes with renewable energy segment. So FMCG one basket which we are avoiding, and then the other basket which we are avoiding this entire FY26 is the pharmaceutical space. There also, to our mind, 15-17% can be the best case scenario for the profitability growth. And the valuations are already stretched for most of those companies. So there also stock price action won't be there.
On FMCG, you said you don't like it, but so far the updates are pretty okay, pointing to some healthy recovery, particularly in the rural market. Urban is also showing nascent signs of a pickup. So is it the valuation that makes you uncomfortable? What is it? And what can change your mind on FMCG?
Yeah, definitely. Yes, Rima, if you look at updates, it has been a low single-digit volume growth. And with blended realization, the best scenario can be made is around 8 to 9% kind of a value terms kind of a top line growth with some stable margins. So if you are compounding at say 10-12% kind of an profitability, valuation definitely becomes a concern if it is available at say 50-55 times 1 year forward PE multiple. So that is the challenge for the entire FMCG basket. Last decade was different. I mean, it was the time when you were looking at stable earnings growth, but going forward, the next decade would be more on the growth drivers where you can find at least 15-20% kind of earnings growth because the index itself is available at 20-21 times PE multiple, and this is likely to continue for at least 2-3 years going forward. So to our mind, it's a growth sectors with sustainable, stable kind of earnings trajectory. I mean, visibility should be there. Those are the sectors which would be driving the growth on the stock price as well, rather than FMCG. It can be at best a trading place. In between, you can get with such, 7-8% kind of blended realization update coming from Dabur or others in the like. You can get a trading pop of 5-7%, but that should be the end of it.
Okay. Dharmesh, you have some cyclical plays as well that you're looking at this juncture where we are in terms of a macro cycle. Some of that which would immediately work out and some which would take some time to see some reward?
Yeah, I mean, the things which can immediately work out is the automobile sector. And there, I think Hero MotoCorp remains our topic. The reasons are very obvious. I mean, one is the valuation comfort is there. It's available at 18x 1 year forward PE multiple. And it is just, the volume sales has just picked up on the entry level side with all the tailwinds of lower EMIs and better monsoon, with festive season coming in, with marriage season already playing on. So I think 550,000 run rate of its motorcycle sales for next 2 months is likely to be in place. And then the base effect also comes into play, because last year, if you look at July, they sold around 370,000 bikes, and August it was 512,000. So there also optically, a run rate of 10-12% kind of a growth would be there. It's already down 30% from its peak level. I think this company can easily command a PE multiple of 20-21. So this is one play which we are liking from the automobile space. Other than like the likes of say M&M or Eicher Motors, so those two are other two different picks which we are liking. And the others as a segment, the theme which we are liking is the entire renewable energy segment, be it IPP like independent power producers like NTPC Green, or solar panel producers like Waaree Energy, or the power financiers like PFC. Again, everywhere there's a huge valuation comfort as well as the compounding of 20-25% kind of earnings trajectory is there. So these are the baskets which we think if you're holding it for 3 to 4 months, decent upside of 10-15% on stock price can be expected.
What about the PSUs? I was about to ask you that question, Dharmesh. Their entire wide gamut that the PSUs have, the stocks have run up significantly, right? Be it the defense names, the railway names. Where is it within the PSU basket other than the RECs and the PFCs where you find comfort, or you do not find comfort in any other space within the PSUs other than these names?
See, I mean, two comfortable spaces. One is defense, but that again is from a long haul. You should not be looking at from 1 year, 2 year kind of a perspective. If you are looking at the defense space from 3 to 5 years perspective, it's a very good bet. I mean, the reason being, if you look at the entire, sales of top, say, 13, 14 companies in the defense space, it is around 70,000 odd crores. You can buy 30 Rafales or, 50 nuclear submarine at that kind of a revenue. So, I mean, plenty of scope there from overall and servicing company to a shift to sub-part and part manufacturing to eventually a OEM kind of a manufacturer. So that is one space which we are lacking from a good investment perspective, but you have to be patient and keep it holding for at least 3 to 5 years. And the other space from the PSU gamut which we are liking is the railway infra space. Again, a lot of modernization and things are likely to take place in the railway space. It's not just metros and, 4-laning or multiple railway line tracks being there. It would be eventually a bullet train kind of system, as is evident in Europe and other countries. So India will eventually migrate to that. That will again entail a lot of capex, a lot of revenues and profitability building into these companies. So there, I think Ircon International looks decent compared to the valuation multiples with relative peers like RVN and all. So these are two spaces which to our mind looks very attractive, but these are long distance space. You should not be looking at it from a quarterly basis, rather look at it from 3 to 5 years kind of perspective.
Thank you, Dharmesh, for joining in and sharing your perspective. For the markets, it's quiet, but with a negative bias. IT is under pressure. Earlier we were chatting with Ravi Menon of Macquarie, and he was talking about how Tech Mahindra is the most expensive large cap IT name. The stock has slipped further. It's now down 1.8% at the day's low. The stock is trading at 30 times FY26 PE, and even FY27, it's above 25 times, so expensive to his mind. HCL Tech has lost nearly 1%. Defense stocks are correcting from last week's up move. Metals are under pressure, namely Hindalco. On the way up, it's consumer, one way. FMCG index is up 1.5%, and in the large cap space, HUL, Tata Consumer, ITC all up between 1 and 3%. We will get into a break on that note. On the other side, we will get you more in the markets, and we'll also talk to you about what's happening with the city gas distribution companies.
Welcome back. You're still tuned into Trading Hour on CNBC TV 18. Well, we've been talking about how this entire oil and gas space has been in focus. On Friday, we got those guidelines coming in from PNGRB. And now there are some notes which are talking about the impact. In fact, Citi has gone ahead and raised the target price on IGL specifically. They have a buy call. The target price is raised to 270 rupees a share. They say they are raising EBITDA margin assumptions from 6.5 to 7 rupees per SCM to 7.5 rupees per SCM. This is because now they're expecting a reduction in transportation costs for gas for these companies. Now remember, all these city gas distribution companies will only have zone 1, which they will consider for tariffs. That won't mean for IGL gas costs would come out, something that we had indicated earlier. This would mean that IGL would be the key beneficiary of the change in these norms, because so far company was in zone 2 and zone 3 when it came to tariff, but now it will be zone 1 where tariffs are the least. In fact, ICICI Security also says that changes in tariff zones will be positive for IGL. However, that would not be the case so much for MGL and Gujarat Gas, because for MGL it could impact their earnings by 3.9%, and for Gujarat Gas it could be impacted by 6.6%. So IGL really tends to benefit the most because of the changes in unified tariffs. Again, we need to know whether tariffs will increase, decrease from here on. That is something we are waiting. GAIL would be in focus on the back of that. But so far, whatever has been the decision by PNGRB tends to benefit IGL the most.
Does tend to benefit IGL the most. The stocks, they moved higher on Friday, not doing a great deal in today's trading session. What's doing not so well today is Jubilant FoodWorks is now down to the lowest point of the day, 4% lower on that stock, but its peers are surging. And how? Godrej Consumer is now up 5.5, almost 5.75 now. Dabur is up 4.5, and the one that has sprung up among the top gainers is Jyoti Laboratories. That is now up almost 6% as we speak. At the highest point of the day is Dabur, and Jyoti Laboratories too at the highest point of the day, 5.5% higher. But with that, we take your leave on this edition of Trading Hour from the trio. Thank you so much for watching. Halftime report on the other side.